How is everybody doing? Welcome to the Strategy Room on this Friday night, March 14th, 2025. Normally doing the Strategy Room on Saturday nights, but I decided I had kind of a family thing going on tomorrow night. I just thought it would be better to do this tonight and get the live stream done for the week. So I thank everyone for being here with me tonight. As always, we have an absolute jam-packed show here for you tonight. Just so much going on in the lovely world of finance right now. I've got all kinds of economic indicators. We're going to talk about tariffs. We're going to talk about interest rates, the bond market. We are going to talk about what's going on with the CFPB and other bank regulators. We're going to talk about what's going on with the national debt. We've just got a million things to talk about and hit on, along with a number of other finance and business related stories as we cover all the main topics and things every single week on this lovely live stream. Okay, so let's kick off tonight here. I wanted to take a look at this, considering we always take a look at the national debt and what's going on. We'll take a look at the Doge clock here in just a minute. But we're going to kick off with this story here tonight. So U.S. budget deficit surged in February, passing $1 trillion for the year to date. And that's obviously a record. And this it's almost unbelievable that in just the first 2 months of the year, we already have a trade deficit that's over $1 trillion. And if you think about that, if our trade deficit is projected to be $2 trillion for the year, and we've already gone over $1 trillion in just the first 2 months, there's no way that we're only going to run a $2 trillion deficit this year. It's going to be way more than that. It's going to be 2.5, maybe even approaching $3 trillion deficit this year. Now, as we all watched, the continuing resolution and everything that got passed today, as a matter of fact, just a few hours ago, finally got passed through the Senate. And all that continuing resolution does is basically kick the can down the road. So we didn't, and no major spending cuts, nothing like that in that bill. So we're going to continue to see basically the burgeoning of this trade deficit as the year continues to go on here, because that CR basically will take us through September, which September 30th is the fiscal year end for the government. The government runs on October 1st, September 30th. Fiscal calendar year, if you were, as it were. So that's going to basically take us through September 30th. They'll have all kinds of negotiations throughout the summer. And at that point, that's where they'll basically try to get into some kind of cuts or something to basically try to get this, under control. But obviously this number is just, it's a crazy number. But let's just look at this for a second. So U.S. debt and deficit problems worsened during President Trump's first month in office as the budget shortfall for February passed the $1 trillion mark, even though the fiscal year is not yet at the halfway point. Government spending eased slightly on a monthly basis, though it is still far outpaced revenue. According to a Treasury Department statement Wednesday, the deficit totaled just over $307 billion for the month, nearly 2.5 times what it was in January and 3.7% higher than February of 2024. Receipts and expenditures set records for the month, a Treasury spokesman said. For the year, the deficit totaled $1.15 trillion through the first 5 months of fiscal 2025. The total is about $318 billion more than the same span in 2024, or roughly 38% higher, and set a record for the period. Net costs to finance the $36.2 trillion national debt edged lower to $74 billion for the month. However, the total net interest payments year to date rose to $396 billion, just behind national defense and healthcare spending. Social Security and Medicare are the largest costs in the U.S. budget. The deficit swelled in the final 3 years of former President Joe Biden's term, growing from $1.38 trillion to $1.83 trillion. Trump has made getting the government's fiscal house in order a priority since taking office, and since taking over, he created the Doge. The advisory board was spearheaded job cuts across multiple departments, in addition to early retirement incentives. Yes, so we'll have more on that, but let's take a look at our Doge clock here. So Checking in here on the national debt clock and how are our friends in Doge doing this evening? Well, they've looks like they've gone over the 200 billion mark. They're now over to 201 billion, and the savings per taxpayer is now up to $1,790 per taxpayer, which is I think that's pretty good. I think that's a pretty good start. Now, there's been a lot of conversation, like how much savings can Doge actually, generate. How much efficiency can they actually bring? In other words, how much actual waste, fraud, and abuse is there? And I think shockingly, we've seen that there is certainly a whole lot more than what people actually thought was out there, right? And it's looking like they're going to generate a lot more. It's looking like they're going to probably get this thing ratcheted up to somewhere in the neighborhood of 500 billion, which is to me is absolutely incredible if they can actually pull that off. Now, the question remains: will they be able to get something to truly significant, like say like $1 trillion or more than $1 trillion? I don't know about that. I really don't know. I mean, I think that remains to be seen. I think at that point you're probably really looking more to Congress and to see if Congress can really get in there and make some kind of deeper cuts or deeper changes to the spending. But we'll see. But like I said, just as we continue to monitor our Doge clock here, again, they seem to be doing a great job for only being doing this for what, less than 2 months here. So. Okay, and then I want to show everybody this story because I thought this was actually kind of funny a little bit. So, more than 200,000 government credit cards are deactivated by Doge. So it says last month, the Elon Musk-led department said it found more than 4.6 million credit cards tied to federal agencies. Now, just in case anybody was wondering, the federal government only has a little over 2.2 million employees, but they found 4.6 million credit cards. It seems kind of crazy. So let's take a look at this here. So the Department of Government Efficiency, Doge, said more than 200,000 government credit cards linked to a handful of federal agencies were canceled after an audit showed they were not being used. Last month, Doge said in a statement that it found more than 4.6 million government credit cards that accounted for more than 90 million unique transactions amounting to more than $40 billion. On Monday evening, the Elon Musk-led agency said that more than 200,000 were deactivated. Weekly credit card update, pilot program with 16 agencies to audit unused, unneeded credit cards. Doge wrote on its X account, adding that great progress was made at the U.S. Department of Health and Human Services and the Department of the Interior. Noting the 4.6 million credit card discovery last month, Doge wrote that there is still more work to do. The post didn't say what Doge will target next. In February's statement, Doge provided details about what agencies are using credit cards and how much they've spent, with the Department of Defense, Department of Veteran Affairs, Department of Homeland Security, General Services Administration, and U.S. Department of Agriculture having the most transactions. The Department of Veterans Affairs spent the most in more than $17.3 billion, while the Defense Department spent more than $11.2 billion, according to the spreadsheet posted on Doge for fiscal year 2024. So again, very, very interesting stuff. I mean, for the first time ever, we're really getting an inside peek at what's going on in some of these departments in the government and how they're using our tax dollars, man, how they're spending this stuff. I did think there was one funny aspect to this. So apparently, they shut down a bunch of credit cards, and then I think a judge basically said, no, you got to turn the credit cards back on. So they turned the credit cards back on, but then I think from the story I read, it basically they made the balance on the credit cards $1. So basically they were useless. So they turned it back on, but they made the balance $1. So I just thought that was really funny. Anyway, so that's kind of a little peek as to what's going on there in terms of the credit cards there. So okay, huge report came out this week. This is the report that I have literally been waiting for probably almost 2 years now, since the banking crisis of 2023. Anybody who's followed my crypto series, I started out the crypto series. The first 4 or 5 parts of that series were really attributed to kind of the history of crypto. I took everybody from kind of crypto starting there in, 08, 09, and taking it up to kind of the first evolution, if you will, through 2015. And then we went through 2016 to 2022, which was really the kind of mania phase that we saw of crypto. And then that led directly into the crypto winter or crypto collapse, if you will, of 2022. And then I led into the banking collapse of 2023. Now, my hypothesis there was that the crypto collapse and specifically the collapse of FTX in the fall of 2022 led directly to the banks that collapsed in the spring of 2023. Now, a lot of people out there have not made that connection. A lot of people basically have tried to point this as, oh, well, these banks had a lot of underlying problems, i.e., unrealized losses in their bond portfolios, high amount of what's called uninsured deposits. So therefore, they had liquidity problems that led to capital problems, which, and then they had basically a good old fashioned run on the bank. And then people basically looked at the social media aspect of this whole thing. Like, in other words, for the first time, because of the effects of social media, that bank run went, like lightning. And instead of the bank run kind of metastasizing over, say, the course of a couple of days or a week, it happened within 24 hours, 24 to 48 hours. And that was it. It was all she wrote. And so a lot of people in the media wanted to paint this banking crisis as, hey, these banks just had problems. It was kind of a classic bank run that got exacerbated by social media and just the speed of how fast people can transfer their money out of the bank and how quickly they could talk about things, online now. And yes, and not that those things were not untrue, but that was absolutely not the whole story. And I think a lot of people, they just didn't understand crypto. They didn't understand crypto. They didn't understand the crypto world. They didn't understand the effects of FTX. They didn't understand that all the banks that failed were the main banks that were in bed with all of the crypto companies. And they just didn't understand this whole aspect of it. So basically, you can look at it like this. I maintain that, yes, these banks did have these underlying issues. They did have unrealized losses in the bond portfolios. They did have a high amount of uninsured deposits. They did have, and those things led to liquidity problems. They led to a certain amount of deposits flowing out. There's no doubt that all those things were true. But it was the collapse of crypto and the fact that all of these companies, hedge funds, VCs, just other companies, they had to cover their crypto bets. They got a margin call, if you will, when FTX went down, and that was the beginning of the sucking sound of all of the deposits being sucked out of these banks. And then that was the match that lit the fire. That was the match that ignited this. And so we're going to take a look at this report. So this literally just came out last couple of days. This was from the Federal Reserve Bank of Chicago. A year ago, I had shared another interesting little. It was a short article. It was only about 4 or 5 pages, but that was, interestingly enough, that was also done by the Federal Reserve Bank of Chicago, which basically said, hey, there might be something to this theory that, of what happened with the crypto companies that failed and ultimately what happened with the banks that failed. So kudos to the researchers and the people over at the Federal Reserve Bank of Chicago for basically doing this research and perhaps thinking in a certain respect a little outside the box on this. So let's read the kind of the abstract here. So this article critically reviews the 2023 banking crisis with the benefit of 2 years of hindsight. We highlight 7 facts that depart from the standard account of the crisis that has developed. We describe the crisis as a reaction to bank business models that focused on providing banking services to certain economic sectors, i.e., crypto asset firms and venture capital, that had come under economic pressure during the preceding year, 2022. We argue this view of the crisis provides a more precise explanation of which banks were affected compared to an explanation focused solely on banks' balance sheet metrics. We also argue that this view of the crisis has different policy implications, more focused on surveilling bank business models and institutional deposits. And wait for it, they might want to think about, instead of, there's all this talk right now about going full bore in, bring crypto in, let crypto get into the bank, let all these banks start having crypto accounts and holding crypto assets and allowing people to trade crypto and all this kind of stuff. Well, maybe we should just pump the brakes on that for a minute. So but here's the report itself. So Rushing to Judgment in the Banking Crisis of 2023, written by Stephen Kelly and Jonathan Rose. And so we just took a look at the abstract. Now I'm not going to bore you to death by reading through this whole thing. I still have not finished going through this whole thing yet. But what I did want to do is I just wanted to show you guys. I wanted to go over the 7 facts that they point to, and then I wanted to just take a look real quick at the timeline because those are the key things you really need to know. So number one. A lot of people think that the first bank to fail during the 2023 crisis was Silicon Valley Bank. No, it was not. It was a much smaller bank. It was a bank that was about $10 billion in asset size, a bank called Silvergate Bank that was also in California, not far from Silicon Valley Bank. But Silvergate Bank was owned and operated by a hedge fund, Silvergate Fund. And they ran what was something called the Silvergate Exchange Network, the SEN network, SEN. Now, I want you to think about it like this. The SEN network, that was the railway, if you will. That was how crypto got from the crypto world into the banking business. It was how they got into bank deposits and how bank deposits get into crypto in the crypto world. So I just want you to keep that in mind here, because we're going to come back to that in a second when we get to the timeline. So number one, Silvergate Bank, rather than Silicon Valley Bank or SVB, was the first bank to fail and the first bank to have a run. That is a fact. Number two, bank business models that materially focused on the venture capital and crypto sectors were at the center of the crisis. Boom. There you go. The 2023 crisis was a crisis of a certain bank business model, not problems with the balance sheet. The business model, Silvergate, SVB, Signature, and First Republic failed. There were a couple other banks. I think First Republic was, and Pacific Western Bank, Western Alliance Bank. These were banks that basically, unfortunately, were just collateral damage. But the 3 main banks at the heart of this thing are Silvergate, SVB, and Signature Bank, because those were the 3 crypto banks, if you will. Number 3, unrealized losses and uninsured deposits are inadequate explanations of which banks experienced runs in 2023. So I have another research paper that basically talks about that these 5 or 6 banks that I just mentioned here were not the only banks involved in this. There were 22 other banks that experienced banking runs at the same time, yet none of them failed. None of them basically even really got close to failure, but yet these banks did, and that's really what it lies at the heart of this. Number 4, while the crisis affected mid-sized regional banks in general, the most severely impacted banks were geologically clustered around the tech and crypto-heavy West Coast. Oh, that's fascinating, isn't it? Number 5, affected banks had been under considerable prior market pressure in 2022 and were not suddenly scrutinized for the first time in March of 2023. Yes, this is a critical thing that cannot be overlooked. One of the big things was that the main regulator that oversaw Silicon Valley Bank was the Federal Reserve Bank of San Francisco. Who sat on the board of the Federal Reserve Bank of San Francisco? Oh, that's right. The CEO of Silicon Valley Bank sat on the board of the Federal Reserve Bank of San Francisco. So the main regulator that was supposed to be overseeing them had the CEO of that bank sitting on their board. Like, you see how messed up that is? And there were a couple other, weird things going on here. But these banks were heavily criticized on their balance sheets, their performance in 2022. So again, for the regulators that were in the know, these things were, these problems that popped up in 23, they didn't shock anybody. They were, because they were already well aware of what the issues were here. So number 6, the historically unprecedented speed of the 2023 bank runs is not well explained by social media or digital banking applications. So this again gets very interesting. So the runs on the affected banks in 2023 were primarily runs of institutional depositors, consistent with historical bank runs. The mobile banking and social media apps blamed in the standard account of the crisis are phenomena that apply to retail depositors. But most of the withdrawals took place through wire transfers, which have been lightning fast for institutional depositors for several decades. Moreover, technological changes are only capable of speeding up bank runs by several hours to a couple of days at most, while the fastest runs in 2023 were at least several days faster than previous bank runs. So definitely more to look at there. And then finally, number 7, the crypto and VC sectors had a special role in triggering the 2023 runs because the affected banks had business models focused on them. Once the runs were initiated, other large, sophisticated depositors ran with roughly the same speed and severity. Boom! There it is, baby. That's what I've been waiting for. That is my admonition right there. That is just proved my hypothesis 100%. Done and done, as they say. Okay, so here is the timeline. Silvergate Bank, like I said, first bank to fail, and they voluntarily liquidated. It's very interesting. They voluntarily liquidated on March 8th. Assets on hand as of December 31st, 2022 were $11 billion. Silicon Valley Bank failed 2 days later on March 10th. They were $209 billion in assets. Signature Bank failed 2 days after that. You beginning to see the domino effect here, right? Signature Bank, $110 billion in assets at the time. And then finally, First Republic Bank failed on May 1st, and they had $213 billion in assets. So 3 of the largest bank failures in the history of the United States. As a matter of fact, numbers 2, 3, and 4 in terms of asset size, 3 of the 4 largest bank failures in the history of the United States occurring in March and May there of 2023. Now, do not forget, do not sleep, do not forget about the fact that Credit Suisse over in Sweden failed on, I think it was March 18th. Credit Suisse failed, and Credit Suisse was subsequently had to get taken over by UBS. Basically, the Bank of International Settlements and everything over there. Those guys had a panic attack and basically said, okay, UBS, you have to absorb Credit Suisse in there. Now, there was a lot of conversation that one of the big reasons why Credit Suisse failed was because they apparently may have had a giant loan out to FTX, which when FTX went down, they could not repay. And that was basically what triggered a lot of what happened there. Now, that's one aspect of this that I have not confirmed yet. I do not know that is to be true. I have not been able to spend enough time, as it were, on that aspect of this banking crisis, but it is something I intend to look into to see if in fact there is some kind of connection there, outside of Credit Suisse just being kind of collateral damage, as it were. But there's one extra piece of this that is missing that I think is absolutely critical to this timeline, which they did not include here, and that is what I mentioned a few minutes ago, the SEN network, SEN, the Silvergate Exchange Network. Remember, that was the main rail system for how cryptocurrency were basically bank deposits were flowing to cryptocurrency. Cryptocurrency was flowing back into bank deposits inside of Silvergate Bank. So what happened was, if I can explain this for everybody so they can understand here. So Silvergate Bank was the main crypto bank. They had the technology. That was their whole strategy. They were all in on crypto. They wanted to be the crypto bank. Silicon Valley Bank and Signature Bank, they had other things going on there. Silicon Valley Bank was obviously they are known as kind of like the techno bank. They were known as the cool techno kids on the block. They did all these kind of venture capital, private equity type financing. They financed all the big tech bros out there in Silicon Valley. And so they had a very unusual business model, and they took a lot of risk that was highly unusual for, I would say, almost any other bank in the country. And they had a very unique model. They did very unique things, and their risk profile was very different than your average bank. Signature Bank was a bank in New York City, and they were a little bit more of a traditional bank, and they had a great model and ran a great bank for a long time. And they, great real estate portfolio, did a lot of great things. But then, they decided to get in bed with crypto and decided to take all these crypto deposits. And now, what part of what was happening was Silvergate Bank was getting so much deposit action that basically they went out looking for other banks and said, hey, anybody else want to get in on this action? And that's how Silicon Valley Bank and Signature Bank come into this thing. They were basically the backup bank. So whatever Silvergate could not handle, that money was flowing back to Silicon Valley Bank and Signature Bank. So, and that's why you see the domino effect here, because and Silicon Valley Bank, their deposits went from literally like 110 billion to like 220 billion. So their deposits went up $100 billion in like 1 year. And when you take a look at that 100 million in deposits that they got in the door, 70 million of that roughly was really related to crypto. But you also have to understand there's a little bit of ambiguity here, because it's not pure crypto. It was also, like a hedge fund who was betting on crypto and had their deposits there. But then those deposits were really, for cryptos or loans and other things that they had with FTX. So, so a lot of people kind of dismissed that and basically said, oh, no, those weren't crypto deposits. Those were just deposits. They're regular deposits that were over here. But it was much more complicated than that. So what happened was the Send network closed down on March 3rd. And the closing of the Send network basically sealed the fate of Silvergate Bank. And that's when all of the panic really kicked in. And then they ran to Silicon Valley Bank and Signature Bank. And these guys lost, hundreds of millions of dollars, went out the door, boom, just like that within a 24-hour period of time. And as they said here, this was all this all came from institutional depositors. In other words, hedge funds, private equity. These were not mom and pop retail investors that were siphoning this money out of these banks. These were big time players. And like I said, and you can see just the absolute domino effect here. The Send network closes on March 3rd. And then Silvergate closes March 8th. Silicon Valley 2 days later. Signature 2 days later, which is boom, 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 boom. And then, like I said, Credit Suisse goes down on the 18th. So it's just amazing to watch this all unfold and all go down. And yet, like I said, a lot of people just did not make that connection between how did crypto, the failure, the blow up in the crypto world in 2022, how that led directly and correlated directly to these bank failures in 2023 and kicked off this whole banking crisis. And this is why I basically say, we have to be very, very careful. The banking industry has to be incredibly careful with crypto, because we know the crypto market can blow up. We know that there are bad actors in the crypto market. We've seen it. We've seen it with a lot of these crypto exchanges, with Binance, with FTX. Just a lot of bad players in the crypto space. And anybody who wants to say that stable coins are super safe, really? Because it was Terra USD. It was the stable coin that was the largest stable coin in the world at the time. And that blew up in May of 2022. And that's what kicked off the entire collapse of the crypto industry that rotated like dominoes. You had a couple hedge funds fail, and then you had what was it? The one hedge fund was Three Arrows hedge fund, completely blew up because of the failure of Terra USD. And then it rolled on to a bunch of crypto for, Voyager, BlockFi, Gemini, Genesis, Celsius, all these crypto firms, all toast. And then it all rolled up into FTX in late October, early November of 2022. And then it was the absolute collapse of FTX. And like I said, and that's what kicked off, to cover the bad bets in FTX, they had to suck the deposits out of these banks to cover those bad bets. And this is partially why Silvergate Bank voluntarily liquidated. How often do you see a bank voluntarily liquidate? Does not happen that often. So, but anyway, I will have more on this in the future after I have a chance to kind of fully digest this report, go back over it. I'll bring it back to everybody, and we can talk a little bit more about it. So, but okay, I want to get into a little bit more some of the articles here of the week, and I'm going to kind of run through a couple of these things a little quickly because we got economic indicators and a bunch of other things to get to as well. So, all right, so watch these S&P 500 levels as benchmark stock index falls into correction territory this week. So the S&P 500 tumbled into correction Thursday amid concerns that Trump administration policies, notably tariffs, could slow economic growth and reignite inflation. The index set a new record high just over 3 weeks ago before promptly reversing, setting up a Wyckoff spring, a chart signal that indicates a market top before a market markdown phase. Investors should watch crucial support levels on the S&P 500's chart around 5,400 and 5,265, while also monitoring key resistance levels near 5,770 and 6,010. So we entered into a correction territory on Thursday, but then I would show everybody today. The Dow pops more than 650 points in relief bounce on Friday, but still post worst week since 2023. So stocks rallied today, clawing back some of the steep losses seen over the week as investors got a reprieve from tariff-related headlines. The S&P climbed 2.13% to end at 5638, and the NASDAQ composite advanced to 2.61. Dow Jones rose 674 points or 1.65% to close at 41,488. So we did get a little bit of a bounce back today in the market. But what did they say there? They said to look for the resistance, monitor key resistance levels at 5770. And basically the S&P bounced back to 5738 today. So not too far off of that. But we'll continue to keep an eye on that. But I just wanted to point out that, yes, the stock markets have moved into correction territory, meaning that the stocks in general are down 10%. For the year. If we were to fall into what's classically defined as a bear market would be a 20% correction. So you'd have to drop another 10% to get into a full bear market position, if you will, what's going on. Right now, I don't. Yeah, right now, I don't know that that's going to happen. We'll see. But like I said, I think the market is gonna rally a little bit, and I think the reality is we're going to have a lot of volatility over the next few months. We just are. We're going to have a lot of ups and downs. We're going to have some good weeks. We're going to have some bad weeks, and I think that's just how things are going to play out. But it's also interesting here. No, you know what? I'm going back to the So right here, this is what I was looking for. So heading into correction territory amid concerns that the Trump administration policies, notably tariffs, could slow economic growth and reignite inflation. Now, we're going to talk about this in a second because we keep hearing this again and again that, these tariffs are going to cause more inflation. Tariffs are going to cause more inflation. No, I've said this a million times. Inflation is caused by one thing and one thing only, and that is government spending. Let's go back to the debt clock here for a second. You see this $36 trillion in national debt? That's where your inflation came from. It came from this. Okay, it's too much spending. You see this $2 trillion budget deficit right here? The $7 trillion in government spending, that's where the inflation came from. That's what's driving the inflation. That's it. And that's all. Tariffs do not cause inflation. And I'm going to show you this in just a second. Now, lost my spot here for a second. Okay, let's come back. But all the headlines have been, oh, the tariffs are going to cause inflation. The tariffs are going to reignite inflation. So part of the reason that we got this pop in the Dow today is because we're going to take a look at some of the economic indicators here over the last couple of days. What happened? Oh, wait for it. Inflation has started to ease a little bit. Inflation, we got the CPI numbers, the PPI numbers, and most specifically, we started to see what? Egg prices starting to drop down. Gas prices starting to come down. So we're starting to see the inflation ease back. And why is that? Because the tariffs are actually going to start to slow things down. And that's what, unfortunately, a lot of these people in the mainline press, this is what they miss, what they don't understand. But let's take a look at this article right here for a second, because I wanted to report on this because I thought it was important. So a few days back, so basically Treasury Secretary Bessent said the White House is focused on the real economy and not concerned about a little market volatility. So Treasury Secretary Scott Bessent said Thursday the administration is more focused on the long-term health of the economy and markets and not short-term gyrations. While Bessent said the administration is attentive to market moves, he predicts that both the real economy and markets would prosper over time. So Scott Bessent basically said, we're focused on the real economy. Can we create an environment where there are long-term gains in the market and long-term gains for the American people? Bessent said on CNBC's Squawk on the Street, I'm not concerned about a little bit of volatility over 3 weeks. The comments come with markets in a state of turmoil, largely centered on President Donald Trump's near daily moves on tariffs against U.S. major trade partners such as Canada, Mexico, and China. Major averages have moved toward correction territory as the Dow Jones Industrial Average has lost more than 7% over the past month. While Bessent said the administration is attentive to market moves, he predicted that both the real economy and markets would prosper over time. The reason stocks are a safe and great investment is because they're looking over the long term. If you start looking at micro horizons, stocks become very risky. So we are focused over the medium and long term, he said in an interview with CNBC's Sarah Eason. I could tell you that if we put proper policies in place, it's going to lay the groundwork for both real income gains and job gains and continued asset gains. So I would just say this. I think the strategy, if you will, is coming into play at this point. So I think they actually are looking to have the market go down here a certain amount. They are looking to slow the economy down a certain amount. They do want to see a softening in the labor markets. I think this is the strategy here, but in doing so, they are going to bring inflation down. And here's the thing. If you want the Federal Reserve to start lowering interest rates, what do you need to have happen? You need to have inflation come down, get back down to their 2% target range. And you have to have a weakening of the labor market. So it's literally a case of things need to get a little bit worse before they can get better. And so if you can get the inflation to back off, and if you do have a softening of the labor market, you will then in turn get the Federal Reserve to start dropping interest rates. Again, we're not going back to zero, but if you can get interest rates, if you can get rates back down to say 5%, that's going to help immensely with getting, just kind of reigniting the economy and getting housing and everything moving forward. So let's take it. So what did inflation do this week? So the consumer price index for both all items and core increased 0.2% in February, slightly below expectations. So on an annual basis, headline inflation was at 2.8%, while core was at 3.1%. Both also were 0.1 percentage points below the Wall Street consensus and the previous month's levels. The report provided some relief as consumers and businesses worry about the looming impact tariffs might have on inflation. Prices for goods and services moved up less than expected in February, providing some relief as consumers and businesses worry about the looming impact tariffs might have on inflation. The Consumer Price Index, a wide-ranging measure of costs across the U.S. economy, ticked up a seasonally adjusted 0.2% for the month, putting the annual inflation rate at 2.8%. But again, here's a nice little chart here. We're looking at cores at 3.1, and then we get all items at 2.8. So definitely, the core that's been the number that's been the most bothersome here. That's what everyone has really been focused in on, not so much the all items, but the core number, because the core has been inching up over 3%. It was, getting up to 3.2, 3.3, and now it has begun to inch back a little bit. So if you can get that core heading back down toward 2%, that's going to be a really good thing. So, but then here's the inflation breakdown for February in one chart. So let's take a look at this chart here real quick. So all items, 2.8%, food at home, 1.9%, food away from home, 3.7%. All items, less food plus energy, in other words, the core number, 3.1%. But what were the big thing? Eggs, 58.8%, beef roast, 5.9%, instant coffee, 8.6%. Olives, pickles, and relishes, 8%. Ground beef, 7.8%. Fish and seafood, 5.9%. Candy and chewing gum, breakfast sausages, apples, oranges. And then it gets a little bit more depth with food away from home. All items left food and energy. So we get video discs, 20.8%. Sporting events, 12%. Motor vehicle insurance, a big one, 11.1%. College textbooks, 10.8%. The veterinarian services, 8.1%. Yeah, I know all about that. I got a ton of cats, man. They're expensive. So we can see this. We get a little bit more sense there for what some of the main culprits are here with some of this inflation. Now let's take a look at the PPI report. Now this is for wholesalers. So this is on the business end of things. So the PPI, the wholesale prices stayed flat in February as egg prices spiked and gas fell. So wholesale egg prices rose 53.6% in February from January, and gas prices dropped 4.7%, leaving an index of producer prices flat over the month. The wholesale prices are a leading indicator of consumer price inflation, but the outlook for the coming months is overshadowed by President Donald Trump's tariffs, which could push up prices. Not likely. An index measuring wholesale prices was unchanged in February from January as falling gas prices and rising egg prices canceled each other out. The producer price index stayed flat in February after rising a revised 0.6% in January as gas prices fell 4.7% and egg prices rose 53.6%. However, as we'll see in a minute, those egg prices have actually started to come down here over the last couple of weeks. Data shows inflation pressure simmered down faster than expected just before President Donald Trump roiled the inflation outlook in March by imposing, revoking, and promising an array of tariffs. And let's just let's go take a look. Hold on. I just stick with me for a second. So, and again, wholesale price measures was flat in February compared with an expected increase. I don't think I had anything really new on that one, but here we go. So egg prices are rapidly falling so far in March. So much for all the tariffs, right? The tariffs causing massive inflation. Egg prices have fallen sharply so far in March on some progress in ending a shortage, giving consumers some much needed relief with the supermarket staple. The cost of white large shell eggs declined to $6.85 per dozen on average last week, according to data from the U.S. Department of Agriculture. That represents a decline of $1.20 per dozen and a 15% pullback, the USDA's prior update on February 28th. Demand for shell eggs continues to fade into the new months as no significant outbreak of HPAI, highly pathogenic avian influenza, otherwise bird flu, have been detected in nearly 2 weeks. The USDA wrote in a March 7th weekly update. This respite has provided an opportunity for production to make progress of reducing recent shell egg shortages. So this will get better. I mean, obviously, we continue to produce more chickens, and we don't continue to have any issue with avian flu. But I would remind everybody that this whole thing was started because Joe Biden, before he left office, he ordered over 100, what was like something ridiculous, like 100 million chickens to be slaughtered. And that's what led to this whole thing. Now, you could argue the whole thing about the bird flu, the avian flu. Some people said that was over exaggerated. Some people said it wasn't as bad as it was. Unfortunately, kind of hard to tell now one way or the other, but there's no doubt that the culling of all those birds, all those chickens, if you will, is what has led to this rapid inflation here. So this will get better naturally over time as we get more bird population back. But it's just good to see here. It's good to see here. Now, 1 month, I would remind everyone, 1 month does not a trend make. We need to see a few months of this going on. But the good thing is that if CPI, PPI, if egg prices continue to come down, if gas prices continue to come down a little bit, we're going to be looking a lot better in just a few months. So, and then let's take a look at a couple other things real quick here. So, job openings see gains in January and a sign of labor market stability. The job openings and labor turnover survey showed that postings rose to 7.74 million on the month, up 232,000 from December, slightly ahead of the 7.6 million forecast. Quits, a measure of worker confidence and the ability to move to other jobs, moved higher to 3.27 million, an increase of 171,000. So job openings increased in January, providing at least a momentary sign of stability as questions linger over the labor market. The Bureau of Labor Statistics reported Tuesday the job openings and labor turnover survey showed that postings rose to 7.74 million on the month, up again 232,000 from December and slightly ahead of the Dow Jones estimate for 7.6 million. The tally kept the ratio of openings to available workers around 1 to 1. Much of the gain from retail, which saw an increase of 143,000 available positions, while finance gained 122,000. Professional and business services saw a decrease of 122,000, and leisure and hospitality fell by 46,000. Now, quits, a measure of worker confidence in the ability to move to other jobs, moved higher to 3.27 million, an increase of 171,000. So while job openings were increasing, hires and layoffs held basically flat. Actions to pair the federal government workforce by the newly created DOGE were not captured in the January data. Just one thing I'd like to say for anybody out there writing these articles and stuff like that, do we really need to keep writing out Department of Government Efficiency led by Elon Musk? Do we really need to keep writing that? Dude, everybody knows at this point. It's called DOGE. We all know Elon's in charge. Everybody gets that. We don't put help us out here a little bit, okay? We don't need to keep spelling the whole thing out. Everybody gets it. For now, the labor market remains stable, but that's January. Yes, so the February report will likely look very different. Federal government openings will plunge, quits will spike, and layoffs could finally begin to rise. In other words, calm today, but turbulence ahead. The JOLTS data provides some positive news for the labor market that otherwise has shown signs of softening. Non-farm payroll gains in February came in a bit below market expectations, and a recent survey from Challenger, Gray, and Christmas indicated a surge in layoff announcements during the month. Most recently, job review site Glassdoor found employee confidence to be at the lowest in the history of the firm's survey going back to 2016. So yes, so again, we're going to keep an eye on this, but yes, I would expect that the February numbers are going to be worse than the January numbers, simply because of the cuts and everything that were made in the month of February to government workers, but we'll see. Continuing on here. So consumer sentiment slumps in March to its lowest level since 2022 as Trump tariffs spark more inflation worries. The University of Michigan survey of consumers for March posted a reading of 57.9, 10.5% decline from February and below the Dow Jones consensus estimate for 63.2. The one-year inflation outlook spiked to 4.9%, the highest reading since November of 22. at the 5-year horizon, the outlook jumped to 3.9%, the highest since February of 1993. While the measure is often prone to disparities between parties, survey officials said sentiment slumped across partisan lines, along with virtually all demographics. Yeah, well, I mean, again, we've had a lot of issues with consumers, right? I mean, consumers are tapped out at the moment. Again, I'm gonna, you know what? I was saving this for later, but I think this was a good time to show this. Dollar General CEO warns consumers are cash strapped and says 2025 won't be better. Dollar General CEO said customers' financial situations have worsened over the past year due to inflation. CEO Todd Vazo said the company doesn't expect the macro environment to improve in 2025. Tariffs and potential changes to government entitlement programs present potential further headwinds for core customers, according to Vazos. So there you have Dollar General CEO basically warning that consumers are cash strapped. And, we have, seen this all, we've been talking about this at length, that basically, what's going on with consumers? Well, let's see here. Savings accounts, savings accounts basically tapped out. Credit cards tapped out. Huge amount of leaning on buy now, pay later. That brew is not a good brew for consumers overall. And as inflation continues to climb, that's just adding, more burden on top every month. So yes, so consumers aren't, feeling it at the moment. So, but like I said, going back to what I said a few minutes ago, I think that you begin to see the strategy here. Basically it looks like the Trump administration, they want a softening of the labor market. They want a softening of inflation. They want to bring these things down. So that basically they can then convince the Federal Reserve to begin to lower interest rates. And then as the changes that they're making to the economy, like basically trying to unleash the private side of the economy, like in other words, get businesses growing again, get small businesses going again, and reducing the size of government, you will then see the economy begin to take off. But again, you're not going to do that in a day, a week, a month. I think it's going to take a couple of years actually to really happen. But you're, like I said, particularly this year, you're going to have a lot of ups and downs. You're going to get these fits and starts as all of this stuff starts to take shape. So I think the goal for this year should just be, keep calm, keep steady. Things will eventually work themselves out. Okay. And then here's a couple other things to take a look at here. So gold surges above 3,000 for the first time as investors seek a haven from Trump tariffs. So gold rose above 3,000 an ounce as President Donald Trump's tariffs against major trade partners triggered deep uncertainty in financial markets. Investors are worried about elevated inflation and a possible recession. Central banks have also been buying up gold as a hedge against rising geopolitical risk. Yes, central banks continue to buy up gold like it's nobody's business. And as a matter of fact, looking at let's go to Twitter here for a second. I'm going to come back to this chart for a second. I'm going to show you guys. This is you want to talk about tariffs from Canada. Here's a list of the tariffs that Canada already has on us. And this is going to make you throw up here, but I'm looking more for right here. Let me see if I can make this a little bit bigger, so hopefully everybody can see that a little bit better. Maybe I'll go a little bit bigger here. Okay, so here you could see big three vaults. So Brinks, J.P. Morgan, and HSBC. Like you could see the amount of gold that's come in here has just absolutely spiked. If you could see it on the far right here, I'm kind of hitting it with the pointer there, but the far right here at the tippy top, you could see there's this absolute, absolute spike here on the chart. You can see how much gold has flowed in just the last, couple of months. Quite extraordinary actually, which is pretty wild. But we're gonna talk tariffs here for a second, and I want to show you guys right here. So let's just look at this for a second. So here is a list are the most outrageous tariffs Canada imposes on the U.S. And by the way, they've been imposing this for a while now. This didn't happen yesterday. This has been years. Chicken, 263% for chicken. Turkey, 179% on turkey. Butter, 175%. Dairy spreads, 165%. Certain fish products, 160%. Milk, 155%. Cheese, 147%. Beef, 77%. Pork, 77%. Eggs, 66%. Flour, 40%. Wheat, 38%. Orange juice, 25%. Peanut butter, 25%. So, they have hit us with an extraordinary amount of tariffs. And so that's why I think this is so hypocritical, again, for the financial news media out there, and even the main media, when they sit there and say, oh, how could Trump put 25% tariffs on Canada? Well, look what they're hitting us with. Look at this. Look at this. I mean, this is ridiculous. This is what they're killing us with, and everybody's freaking out because we're hitting them with 25% when they're hitting us with 263% on chicken, and 175 on turkey, and 179 on turkey, 175 on butter. Like, are you kidding me? Like, it's just like I said, when you understand the real numbers, it's like bad comedy almost. And this gets back to my whole point of, we don't have free trade. We do not have free trade. Is a fantasy. Everybody else gets free trade, and the United States gets completely and totally taken advantage of. That's what we get. But anyway, I digress. So, okay. All right. Now here's, so we talked about, gold rising up. Now here's an interesting. So this is weekly mortgage demand surges 11% higher as interest rates drop for the 6th straight week. Oh, wait a minute. So now let's go back and look at the trend pattern here for a minute. So we have inflation as per the CPI and the PPI beginning to wane a little bit, beginning to pull back a little bit. We're seeing gasoline prices drop. We're seeing egg prices begin to drop this month. And now we've got mortgage demand surging a little bit because, wait for it, interest rates are also beginning to drop down. The Treasury, the 10-year Treasury, which drives everything, is beginning to come down. You're starting to see something here. So are tariffs really driving all this damage that they're supposed to be driving? No, not really. So the average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances of $806,500 or less decreased last week to 6.67% from 6.73%. Applications to refinance a home loan, which are most influenced by weekly rate changes, increased 16% from the previous week and were 90% higher than the same week 1 year ago. Applications for a mortgage to purchase a home rose 7% for the week and were 4% higher than the same week a year ago. So mortgage rates declined for the 6th consecutive week, with the 30-year fixed rate dropping to 6.67%, the lowest level since October of 2024, said Joel Kahn, an MBA Mortgage Bankers Association, MBA economist, in a release. So again, that's the little, not great, nothing great, nothing fantastic, but it's a little bit of good news there. And so let's peek in here. Well, I gotta tell you what, we'll take a look at tariffs and interest rates in just a second. But so now that we've looked at all of this data, right, we've seen inflation easing off just a tad. We've seen, labor market hanging in there, so to speak. Again, egg prices, gas prices coming down, whatever. So what does the Fed think of all of this right this minute? And so they basically chimed in, why this week's positive inflation reports won't look as good to the Fed. So on the surface, February's inflation data brought some encouraging news, but underneath there were signs likely to keep the Fed on hold when it comes to interest rates. While the consumer and producer price indexes both were lower than market expectations, that won't necessarily be reflected in the main PCE price index measure the Fed uses to gauge inflation. In short, progress on inflation has started off 2025 on the wrong foot, Bank of America economist Stephen Junot said in a note. On the surface, February's inflation data released this week brought some encouraging news, but underneath, there were likely signs to keep the Federal Reserve on hold when it comes to interest rates. Fine, we get it. And of course, they'll still, of course, I can already tell you the rest of the article without even looking at it, like, oh, tariffs are still a problem and they could cause inflation. Okay, well, we'll look at that in just a second. But basically, this isn't enough to change the Fed's mind, right? Like the Fed is still going to sit on kind of a wait and hold attitude and say, okay, we'll wait to see what happens with all that, and we'll go from there. So, all right, and now we get the kind of tariffs. So, okay, before, do I want to go into this? I'm just trying to think. I'm looking at time here. So I'll tell you what, let's hold off on this for a second, because I do want to get to, it's usually this time in the show where I like to go back. I want to talk about what are the economic indicators that are coming out next week. And I also want to talk about the 5 episodes that I did this week that I put out. And then, like I said, let's run through that stuff real quick. I like to run through a little bit of other banking news. And then, like I said, then we'll get back to those articles and stuff here in just a minute. So first off, let's look at what economic reports do we have coming out this week coming up. So on Monday, March 17th, we get retail sales. We get the New York Empire State Manufacturing Index. We get business inventories, and we get the Atlanta Fed GDP Now numbers at 2:00 on Monday. So that'll be good. Tuesday, March. Actually, I should say that. That's actually not good. Their numbers are probably going to be negative GDP, so probably not going to be that great. Tuesday, March 18th, housing starts, industrial production, 20-year bond auction, and API weekly crude oil stock. And oh, by the way, the 30-year auction that we just had, I think a day or two ago, was pretty weak. Just to note that. So Wednesday, March 19th, we're going to get interest rate projection, FOMC economic projections at 2:00, Fed interest rate decision at 2 p.m., and then FOMC press conference at 2:30. So Wednesday would be a very big day. Thursday, March 20th, continuing jobless claims, initial jobless claims, Philadelphia Fed manufacturing index, existing home sales, and U.S. leading index. So big week for market data. My guess is on Monday we get the preliminary Atlanta Fed GDP Now numbers, which are probably going to show negative GDP growth so far for the first quarter of 2025, but again, that is going to add to the case. Again, if you're following with me here, if we continue to get a softening of inflation and can continue to get a softening of the labor market, and we get a negative GDP number. Remember, the definition, the classic definition, if you will, of a recession is 2 straight quarters of negative GDP growth. So, if we do get 2 straight quarters of GDP growth and the market comes down a little bit more and we get a softening of inflation, a softening of the labor market, it's going to be pretty hard by June and July. It's going to be pretty hard for the Fed to continue to just sit there and say, you know what, we're not going to reduce rates any further. We're not going to do anything. But on Wednesday, I'm not expecting the Fed to do. They're going to do bupkis. They're not going to do anything. They're just going to stand pat. Jeremy Powell's going to come out. I could literally write the speech for him right now. He's going to say, we need to see more data, and we're going to continue to monitor the economic trends, and we will make our decisions based on that data. And we're just not seeing enough right now, especially with inflation. The labor market remains steady, and we just haven't seen enough yet. And we're still very highly concerned by those tariffs from Donald Trump. So, so after that, so watch the Fed speech there on Wednesday and see how I just did. So, okay. What did I have in terms of episodes that I put out this week? So again, I usually put out an episode Monday through Friday. I really try to keep the episodes, 10 to 15 minutes in length. The idea being that hopefully most people can just kind of consume them if they're driving around or at the gym or something, listening, that they can consume this stuff rather quickly. So I did on Monday, I released episode 337. How can community banks compete against non-bank lenders in commercial real estate? Now, this was a little interesting because it kind of got into the private banking, private credit, which was a topic that I've talked about in a couple episodes already, the kind of emergence of that private credit market. So basically the episode examined a two-part blog post from PCBB, which was titled CRE Lending Part 1, Non-Banks Fill Gaps, Not Expectations, and CRE Lending Part 2, Strategies to Compete with Non-Bank Lenders. And I just asked, the question, what is the growing role of private non-bank lenders in commercial real estate? Do borrowers have frustrations with non-bank lenders? Yeah, I'll save you the suspense. Yes, they do. And then what can banks do to compete and win? So like I said, if you're kind of interested in that competition from non-banks, private credit, private lending, that was, again, I thought, very interesting episode. Then on Tuesday, I did episode 338. Is private equity good or bad for small businesses? And I thought that this was a really good episode because this episode examined 3 articles from CNBC, S&P Global Market Intelligence, and the Business Journals. The CNBC article basically was how private equity played a role in the failures of Rock Lobster and TGI Friday's bankruptcies. The Business Journal article is titled Where Private Equity Firms Invested Billions into Small Businesses in 2024. And then the S&P Global article was Private Equity Deals in Asset Management Sector Hits a 3-year High. So the 3 articles are used to provide the audience with a better understanding of how private equity is investing in small businesses and whether those outcomes are beneficial. And in the article, we talk about a couple of the strategies that private equity uses, such as, roll-ups and sale leasebacks, and some of the different things that they do that can be, it can be positive. I think there's a lot of positive and a lot of negative. And I think that's what makes that interesting. That makes it a very interesting story about private equity and what private equity does with small businesses and whether or not, it really makes sense or not. And then on Wednesday, I put out episode 339, which was Community Bank CEO Outlook for 2025. So if anybody listened last week, last Friday, I did an episode 336, which was basically a CFO roundtable where I basically looked at a CFO roundtable, had 6 CFOs participating in it, asked them a bunch of questions, and we got to see a glimpse into how do bank CFOs feel about the economy, feel about the banking environment right now? What are some of the big things in banking that really have them concerned or have, things that they are keeping an eye on the horizon, if you will? So we got that opinion last week. And so this week I did basically the Community Bank CEO Outlook for 2025. So, and then this episode examined an article from Independent Banker Magazine, which was titled 2025 Community Bank CEO Outlook, Balancing Between Deposits and Loans. And the article is based on a survey that is performed by the Independent Banker every 3 years. And the purpose of the survey is to ascertain how community bank CEOs are feeling about the current banking environment. And some of the topics that are discussed include raising deposits, loans, marketing, differentiation, treasury management, and new technology. So again, some really interesting comments, really interesting opinions from a number of community bank CEOs around the country. So like I said, if you want to listen to that, check out that episode. Then on Thursday, yesterday, I did episode 340, which was part 17 of the crypto series. So just continuing on. And I basically talked about the recent crypto summit at the White House and the announcement that there was going to be a creation on the part of the government of a strategic crypto reserve. So again, in this episode, we reviewed recent crypto-related stories, including the first ever White House crypto summit, the creation of a strategic cryptocurrency reserve, and who are some of the key players from the crypto world trying to influence the government's role in crypto and ultimately the regulation that is inevitably to come. And I have some news on that front in just a second. So again, just continuing that crypto series, continuing to report on kind of all things crypto. And hopefully if you haven't checked that out, go, check that out when you have get a second. I think the crypto series is pretty cool. I've covered a lot of different ground, a lot of different stories, documentaries that were made, a lot of history of crypto, different, just a lot of different things going on there, fraud cases, all kinds of stuff in there. So little something for everybody, as it were. And then earlier today, I had came out episode 341, which was called Tariffs and the U.S. Trade Deficit. And this episode takes a deep dive into tariffs and the U.S. trade deficit. And I talk about what are tariffs? How does the U.S. trade deficit play into the tariffs that are being instituted? Are tariffs really a bad thing? And then finally, will our economy be dramatically disrupted by the tariffs? I think yes in the short run and no in the long run. Basically, and you have to understand the trade balance. Like if you really want to understand this topic, and I'm going to talk a little bit more about this in a minute when we go back to the articles, but if you really want to understand tariffs and what's going on, you have to understand the trade deficit. You have to understand how far in the hole we are on the trade deficit and understand that the trade imbalance there. Like I just showed that chart, right here. I just showed this a few minutes ago, with the tariffs here from Canada. So again, once you understand this imbalance, you're going to understand a lot more about the tariffs and what goes on there. So like I said, we'll come back to that in just a second. So, but those were the 5 episodes that I put out this week, and I really thought that these were some of the best episodes that I've put out year to date, and I was really hoping that people would really love these episodes and really check them out. So if you get a minute, please make sure to go check them out because I think you will, really enjoy them. So, okay, let's get to some other news here real quick before we go back to the articles. So, Bill Pulte was confirmed to head the Federal Housing Finance Agency. The Senate voted 56-43 to confirm the ICBA supported nomination of William Pulte to be director of the Federal Housing Finance Agency, which hopefully is a good thing. So the Senate committee advances stablecoin legislation. I just said I had some more news on this. So the Senate Banking Committee advanced bipartisan legislation to establish a federal supervisory framework for stablecoins and their issuers. The Guiding and Establishing National Innovation for U.S. Stablecoins, GENIUS Act. You gotta love these names. The GENIUS Act passed the committee on a bipartisan 18-6 vote. The committee unanimously adopted a manager's package prior to the vote that included an amendment by Senator Mike Rounds and Lisa Blunt from Rochester, addressing problematic language that could have granted non-bank issuers access to Federal Reserve master accounts. So again, a lot more news, I'm sure, to come on this topic, but good to check out anyway. CISA, the Cybersecurity and Infrastructure Security Agency, it had an advisory on ransomware. So CISA, the FBI, and Multi-State Information Sharing and Analysis Center released a cybersecurity advisory on Medusa ransomware activity. So CISA said Medusa is a ransomware as a service variant used to conduct ransomware attacks affecting more than 300 victims. Medusa actors use common techniques like phishing campaigns and exploiting unpatched software vulnerabilities. So CISA encouraged network defenders to review the advisory and implement the recommended mitigations to reduce the likelihood and impact of ransomware incidents. So if you're not on top of that, I would suggest you get on top of that. So ICBA, evolving AI regulatory frameworks must be proportionate and fair. So the ICBA said artificial intelligence has the potential to significantly enhance the operations of community banks by improving efficiency, strengthening risk management, and enhancing customer service, but regulatory frameworks must evolve in a way that supports innovation while safeguarding consumers' protections and financial stability. So in a comment letter to the National Science Foundation on the development of an artificial intelligence action plan, ICBA said community banks recognize the opportunities and challenge AI presents within the financial services sector and urge the administration to ensure community banks remain central to the conversation. So again, just as with the cryptocurrency regulation, we'll have to keep an eye on that. And again, yeah, more conversation on the whole stablecoin thing. If I can flip through these pages here. So, okay. ICBA encourages Congress to end tax subsidies for credit unions over $1 billion in assets. With Congress considering legislation to reform the nation's tax policy, ICBA called on policymakers to end unwarranted federal tax subsidies for the nation's largest credit unions. Introduced by ICBA President and CEO Rebecca Romero Rainey at ICBA Live in Nashville, the new policy resolution calls on lawmakers to end the federal tax exemption for credit unions with $1 billion or more in assets, or to establish tax parity between credit unions and tax-paying community banks. Eliminating the federal tax exemption for credit unions over $1 billion in assets will help ensure taxpayer dollars no longer tilt the competitive marketplace, subsidize community banking consolidation, and result in fewer choices for consumers and small businesses. So, yeah, I agree with that. I think they should absolutely 100% do that. Okay, and then FinCEN issues Southwest border targeting order. So the Financial Crimes Enforcement Network issued a geographic targeting order to combat the illicit activities and money laundering of Mexico-based cartels and other criminal actors along the southwest border of the United States. Let's see what else I got here. ICBA opposes House bill to set credit card rate cap. So ICBA and other groups expressed opposition to House legislation that would establish a 10% annual percentage rate cap for credit cards. I know they're opposing this one, but if I was a betting man, I would say they're not going to get it because I think I think this is highly popular with consumers right now, especially consumers who are drowning in credit card debt. Hey, you're going to tell consumers that you're going to cap credit card rates at 10%. They're obviously going to love that. I think in certain respects, it's kind of an easy win for politicians because you look at both sides of the aisle. I mean, that's going to be pretty nonpartisan. I mean, who amongst Republicans and Democrats is not going to vote to cap credit card rates to help out consumers? I mean, I look at that. That's an easy win for both sides, right? So they can oppose that all they want. I don't think that's going to happen. Financial Services Information Sharing and Analysis Center's latest weekly risk summary shared a be on the lookout report for new ATM and bank branch account fraud attempts. According to the FSISAC, fraud actors are opening multiple business accounts in New York and New Jersey using the same Chinese passport as ID, making ATM cash deposits of $10,000 or less. They are also opening accounts using Cash App transactions ranging from $10,000 to $30,000. So after opening the accounts, fraudsters deposit hundreds of thousands of dollars in ATMs. Within days, sometimes the same day, the threat actors withdraw funds via cashier's check in a branch location. So interesting. So just have to keep an eye on that. Let's see here. The ILCs, the industrial lending corporations, could harm consumers and threaten the economy. So allowing large corporations to form industrial loan companies would magnify risks in the financial system and could ultimately give big tech firms access to information about every aspect of a consumer's life. No, actually, open banking will do that, but that's all right. That's my little insider open banking joke. The article notes that community banks have long opposed the ILC formation, with critics saying industrial banks are the result of a legal loophole because the parent company can benefit from its bank's access to the federal safety net, such as emergency loans from the Federal Reserve, without facing regulatory supervision of the entire enterprise. So, the ILC thing has been a big thing in banking for a long time. I am going to, stay tuned. I am going to cover the whole ILC topic in an upcoming video, which will come out, this week, next week, but like I said, keep an eye out for that. Okay. Some other reports came out. This was kind of big news this week. The OCC, the Office of the Currency of the Controller, OCC, issued new crypto asset guidance this week. So the OCC issued new guidance for crypto asset activities that rescinds previous guidance that said banks must demonstrate to the satisfaction of its supervisory office that they could engage in permissible cryptocurrency or crypto asset activities in a safe and sound manner. The OCC, which withdrew from joint statements issued with the Federal Reserve and FDIC, said in its new guidance, they reaffirms that the crypto asset custody, distributed ledger, and stablecoin activities discussed in prior letters are permissible, is intended to reduce the burden, encourage responsible innovation, and enhance transparency. And banks and will ensure that bank activities will be treated consistently regardless of the underlying technology. Again, I have to say, I'm a little concerned with, just opening the door, to get all these, crypto assets into the banking world. I just don't know about that. I just don't know that is a good idea. But I love, and this is last thing on here, as far as bank for bank news. So the ICBA supported anti-CBDC bill is reintroduced. So House Majority Whip Tom Emmer reintroduced the ICBA advocated legislation restricting the ability of the federal government to introduce a central bank digital currency. A similar bill passed the House during the last Congress. So, So this is called the CBDC Anti-Surveillance State Act, H.R. 5403. This bill would prohibit the Federal Reserve Bank from offering products or services directly to individuals, maintaining individual accounts, or issuing a CBDC to individuals or through an intermediary. Prohibits the Federal Reserve and the Federal Open Markets Committee from using a central bank digital currency to implement monetary policy. So I think that's a great thing. I just hope they can actually get it through. So, but we shall see. So, okay. All right, let's get back to some of the articles here. We still got a couple minutes left. Sorry, guys. I need a drink here before I jump back into this stuff. Okay. So tariffs take the bond market for a ride. So what's next? So like stock traders, business owners, and consumers, bond investors have struggled to make heads or tails of President Donald Trump's on-again, off-again tariff policies. The yield on the 10-year U.S. Treasury note soared after Trump's election, but has since fallen on uncertainty. What happens at the Federal Reserve and in the stock market could influence where the bond market goes next, experts say. So the bond market is confused over what to make of President Donald Trump's quickly shifting trade policies. So let's take a look here at bond yields, shall we? So what has happened here? Let's take a note at the big daddy one. Let's take a note at the 10-year yield. So this closed up at 4.3%. So we could see over here on the chart that it kind of bounced up a little bit here today, but it had dropped early in the day. It had dropped to 4.2%. But if we go back, let's look at the 5-day chart. It had dropped down to 4.16%. And then at the end of the day today, it was back up to 4.3%. So it has been fluctuating a little bit with some of the volatility there. But you could see here that yields yields have been coming down. The 5-year note is down to 4.05 or 0.95, 3-year 4.013, 2-year 4.030. 1 year 4.08 to 4.080. 6 month is still at 4.2%. 3 month is 4.2. The 1 month is 4.2. So again, these treasury yields are coming down a little bit, which is helping interest rates. Everything that you have on the consumer side, your credit cards, your auto loan, your mortgage, the 30-year mortgage, it is all tied to the 10-year treasury. So that is always the thing you want to look at. You always want to look at the 10-year treasury rate because that's going to let you know ultimately that is what is going to influence all of those consumer interest rates for any kind of debt on the consumer side that you're going to take out. So keep an eye on the 10-year. But like I said, this has gotten a little bit. It has gotten a little bit better, in more recent days. Let's take a look at 3 month. Let's look at the 3 months. So we could see here that basically it was at its high on January 13th, where it was at almost 4.8%. And it has come down since. And like I said, ending today at 4.3%. So it's come down about, almost about 50 basis points off its high, which is great. You want to, again, we're hoping to continue to see that. So now This is a great article here. So, tariffs threaten rapid reversal in U.S. inflation as price growth slows. Let me say that again. Tariffs threaten rapid reversal in U.S. inflation as price growth slows. So the cooling of U.S. inflation in February, which rose for months, may be a short-lived trend as the impacts of Donald Trump's flurry of tariffs begin to take root. So the consumer price index in February rose 2.8% from a year earlier, down from the 3% increase in January, and the smallest annual inflation increase since November of 2022. The Bureau of Labor Statistics reported March 12th core inflation, which excludes volatile food and energy, increased 3.1% in February, the smallest increase since April 2021. The Bureau's data showed. So we could see, inflation here. We had the big spike up, obviously 21, 22, and then beginning to come back down. So while inflation growth is moving toward the Federal Reserve's 2% goal, tariffs on billions of dollars of imported goods have yet to be reflected in the data, and the future is murky due to U.S. trade policy uncertainty. We should expect to see some of the impacts of tariffs on inflation beginning in the March data, said Steve Wyatt, Chief Investment Strategy for BOK Financial. The materiality of those impacts is a question we all have, including the Fed, as how the tariff costs are spread between producers, distributors, and consumers is a real question mark. So, and again, it just kind of looks into some of the different inflation numbers that we looked at earlier this evening. But again, just pointing out that we are going to be on a little bit of a roller coaster here with tariffs, right? Like this is going to cause, we're going to see some ups and downs in this. But like I said, at least for the short term moment, going back to this for just a second, we are seeing the 10-year Treasury yield come back down. We are seeing, at least this month so far, we saw inflation ease a bit. So the question is, will this turn into a trend? We need another 3-4 months of this to basically determine if we are entering a trend, or at least in a positive trend at that. So, all right, but let's go into now. I just want to hop into a couple articles here. So banks, so let's talk about federal regulators for a minute. Like obviously we're going to look at an article here in a second on the CFPB. But I wanted to point this one out first. So that's banks want federal regulators to better coordinate, not to necessarily consolidate. There's been a lot of talk that there's going to be the major consolidation of a number of U.S. bank regulators. So the long discussed idea of consolidating U.S. federal bank regulators is once again a talking point, but many in the industry would settle for improving the coordination between the agencies. The topic of regulator consolidation has been bandied about for decades and was suggested in Project 2025, an often cited conservative policy playbook. Bankers are starting to see signs of lighter regulation under President Donald Trump's administration, and the breakneck pace of change in Washington is adding to speculation about consolidation. However, Treasury Secretary Scott Bessent seemed to throw cold water on the notion. We need our financial regulators singing in unison from the same song sheet, Bessent said during a speech March 6th. To be clear, this does not mean consolidation of agencies, but coordination via Treasury. Still, the policy stances of the current administration have been fluid, and previous reports have noted that combining bank regulators is something the president's advisors had considered. In general, bigger banks, which interact directly with multiple federal regulators, are more open to agency consolidating. In February, Bank of America Corp Chairman and CEO Brian Moynihan noted that combining regulators has become more feasible given that the depository industry itself has consolidated. As of the end of 2024, there were 4,543 U.S. banks, which is way, way down. The idea of national regulatory consolidation, even on a dynamic country like the United States, is probably more appropriate today than it was when you had 10,000 or 15,000 banks all distributed all over, Moynihan said at the Economic Club of Washington, D.C. on February 25th. Smaller state-chartered banks tend to deal with one federal regulator, and they are more wary of a push for consolidation. The Independent Community Bankers of America said Wall Street bank executives and others have called for the idea of merging regulators. So while community banks are strong advocates for streamlining federal banking regulations and building efficiencies, structural reforms are better focused on protecting agency accountability by enacting board oversight at the federal banking agencies with meaningful community bank representation and ensuring regulatory oversight is tiered and risk weighted. Yes, I agree. I definitely agree with that last comment. That making sure that regular oversight is tiered, because the reality is, you cannot regulate Bank of America like you do a small community bank in Minnesota. Like they're just two completely different animals, if you will. Like you have to, we have to have tiered and weighted, oversight on these different size financial, organizations. That being said, there are 17, 18 banking regulators. We don't need 17 or 18 banking regulators. You don't need them. We could absolutely get rid of, I think we could get rid of 7 or 8 of these banking regulators and it would be fine. And quite frankly, nobody would miss them. And we would save the industry and the government a ton of money. So why not? I mean, I've often asked the question, you look at like the FDIC. I think they have about 6,000 employees, $3 billion annual budget. Is all that necessary? I don't know. I think you could make, there's arguments on both sides of that, but I think you could make a pretty compelling argument that with 4,500 banks, maybe the FDIC doesn't need 6,000 employees and and a $3 billion budget. So I think that there are some things that could definitely be changed there. But let's take a look at this article for just a second. So here's why banks don't want the CFPB to disappear. So for years, American financial companies have fought the Consumer Financial Protection Bureau in the courts and the media. Now, with the CFPB on life support after the Trump administration issued a stop work order and shuttered its headquarters, the agency finds itself with an unlikely ally, the same banks that reliably complained about its rules and enforcement actions. If the Trump administration succeeds in reducing the CFPB to a shell of its former self, banks would suddenly find themselves competing with non-bank financial players, including big tech and fintech firms with far less federal scrutiny than FDIC-backed institutions. Payment apps like PayPal, Stripe, Cash App, and those sort of things, they would get close to a free ride at the federal level, says David Silberman, a veteran banking attorney. So, okay, there might be some truth to that, but let me ask you this. Why does the CFPB need to do that? You couldn't give that responsibility to one of the other 17 banking regulators. If that's your argument for keeping the CFPB, that's a BS weak argument that holds no water. That is a menial, in my opinion, that is a menial task that could easily be given to another. Right? You could give that to the FDIC. You could give it to the OCC. You could easily have one of those other guys pick that up and do it. I make no bones about the argument. I hate the CFPB. I have always hated the CFPB. I have felt it was always more about politics than it was about helping the consumer. And they try to make it like, oh, the CFPB was this great consumer advocate and they were out there fighting for the little guy and people could put those complaints in there. Okay, you could put a complaint in. Did they ever do anything with it? No. So it's again, it became, and especially in this last administration, the CFPB has always been highly politicized, but in the last administration, it went turbocharged on being politicized. So no, I don't like, again, I don't see any reason to keep get rid of the CFPB, put the stake in the heart, man. And here's the funny thing. Is anybody going to miss the CFPB when they're gone? No, nobody is going to miss the CFPB. Nobody. Okay, so let's just get to some other news here real quick. So Square Financial Services receives FDIC approval to offer the Cash App Borrower. So I just thought this was kind of interesting. So Square Financial Services, a subsidiary of Block, received approval from the FDIC to begin offering the consumer loan product Cash App Borrower. Square Financial Services, which currently provides business loans and interest-bearing deposit savings accounts through Square Loans and Square Savings, will offer small, easy-to-repay consumer loans to Cash App customers. As of December 31st, 2024, the average Cash App Borrow loan was less than $100 and about 1 month in duration at a fraction of the cost of a payday loan or overdraft fee. As smaller and shorter term, than what a typical bank offers, according to a new news release, by Block. Available to eligible consumers who utilize Cash App, the short-term credit product has been strong product market fit with nearly $9 billion in originations in 2024, offered by Block through an external bank partner. So yes, just very interesting there. Square, or I should say Block, kind of partnering up to offer, this kind of payday lending type service through Cash App. So interesting news I thought would come out there. U.S. underemployment measure surges, signaling a weakening labor market. So while U.S. employment remains near historic lows and has moved little over the past year, a more complete measure of joblessness surged in February, rising to levels last seen in 2021 as millions more Americans struggle to find full-time work and labor demand continues to weaken. The underemployment rate, also known as the U6, my favorite indicator of unemployment, which I said is the real unemployment rate, and referred to by some economists. Referred to as some economists as the real unemployment rate. Thank you. Jumped 50 basis points in February from January, reaching 8%, its highest level since October of 2021. The U.S. Bureau of Labor Statistics reported March 7th. The U6 measure of joblessness gauges the unemployed and underemployed, those out-of-work Americans who have grown discouraged and given up their job hunts, and those marginally attached who have left the workforce but may soon return. That basically hit 8%. And I would always say that is the real unemployment number. So we'll have to definitely keep an eye on that. U.S. banks' construction loan delinquency ratio rose in the fourth quarter of 2024. So the delinquency ratio for construction loans at U.S. banks rose sequentially for the second consecutive quarter in the fourth quarter of 2024. Delinquent non-residential construction loans rose to $4.66 billion, or 1.18% of total non-residential construction loans as of year-end 2024, from the $4.59 billion, or 1.15% a quarter earlier. Now, so we could see this rising delinquency in construction over the second half of 2024. Not a good trend, definitely not what you want to see. Now, I think banks have worked to contain this a little bit by basically reining in some of their construction lending, if you will. But still a troubling thing because you still got a lot of construction loans in the pipeline. Basically, you got $4.66 billion, and this is just delinquent. That's not your total construction loans, just what's delinquent at the moment. So this is a trend here we'll definitely have to keep an eye on. Obviously, if this, in a couple of months, when we get the first quarter of 2025, if that continues to go up, that will be an issue. So amid stock rout, value of bank bond portfolios set to improve. So, with this kind of stock, so it's not, the stock rout is not all bad. So banks have this huge problem with what's called unrealized losses in their bank bond portfolios. And you could see that since the fourth quarter of 2021, this has been a major problem for banks, and just, has been a huge, you're talking negative $233 billion in their bond portfolios. So this is not, this has been lingering for years now. It is still a massive problem in the industry, and even with the market coming down, getting a little relief in the bond market, this is still a huge problem that we're going to have to keep an eye on. U.S. restaurant employment falls amid immigration policy changes. So after months of uninterrupted growth, the number of U.S. restaurant workers dropped for 2 straight months, and hiring has slowed to near the lowest level in years. A possible sign that the Trump administration's efforts to enforce stricter measures on illegal immigration is taking root in the industry. Employment in food services and drinking places was just under 12.31 million in February, down 57,000 workers from December of 2024, when employment in the industry reached an all-time high, according to the latest government data. So you can see here from this chart, restaurant employment may have peaked in December of 2024. All employees, food service, and drinking places in the millions. So you can see from January of 2021, it went from probably about 9.7 million all the way up to 12 million. Interesting. What happened from January of 2021 over the last 4 years. There was a certain administration. It was just kind of letting immigration run wild, right? And we saw from looking at all the job reports over the last 18 months that basically most of the bulk of jobs were going to what? Foreign-born workers. Yes, so you definitely see this here. So I would expect that if you're looking to get a job working in the restaurant space, there should be plenty of openings for you coming in the next year or so. So okay, there's some other quick news. TD Bank closing 38 branches, including 4 in the Philadelphia region. Obviously, TD Bank continues to struggle now with the asset cap and other issues that they've got going on there. Trump's SBA has mostly focused on cuts, but here are the loan programs it wants to expand. I'll save you this. They basically want to continue expanding the 7A program and get some of the others like express programs and things like that. They want to continue to keep some of that going. Death by 1,000 cuts. Philadelphia developers say Trump tariffs will kill real estate projects. So obviously, you have a lot of developers, especially in the real estate industry, highly concerned about the tariffs and if that will rise costs on them, which will hurt, again, construction projects or, especially future projects. So Doge cancels almost 20 office leases in greater Philadelphia. So definitely Philadelphia getting hit with a cancellation of a lot of office leases. And that plays into this article here, the federal government real estate shakeup. Could this shift the balance from owned to leased space with the government basically canceling all these contracts, not only in Philadelphia, but all across the United States? So again, we're going to keep an eye on this. I'm sure there's going to be a lot of updates in this in the months ahead as a lot of these government contracts get canceled. Consulting giants face a reckoning as cuts intensify. I thought this was interesting. So some of the biggest consulting firms in America are in the crosshairs of federal cost-cutting efforts, the latest sign of turbulence in the industry. So Doge, again, I love how everybody's got to spell this out. Like, we don't know what Doge is. We don't know that Elon Musk is doing it. Some actions of which were later retracted or corrected for smaller amounts. Okay, whatever. So in recent days, Doge has also directed the General Services Administration and other agencies to identify contracts with some of the biggest federal consulting firms to assess whether they can be terminated. Firms with contracts being scrutinized, including Accenture Federal Services, Booz Allen Hamilton, and Deloitte Consulting. So, so it says basically the consulting industry rocked by tech advancements and other changes. So the consulting industry, long a profitable mainstay of both government agencies and Fortune 500 companies looking to transform their offerings, seek strategic alternatives or downsides, is facing myriad obstacles with the possibility of federal cuts only the latest hurdle, experts say. Having spent years managing government contracts, I've seen how deeply consulting services can influence an agency's success. Says George Carrillo, CEO of the Hispanic Construction Council. Yet, with the recent push from the GSA to cut non-essential consulting contracts, it feels like the landscape is shifting under us. He said artificial intelligence and automation are accelerating these changes, reshaping how work is done and cutting demand for consulting services. He said tools such as Deloitte's Cortex AI can analyze massive data sets in minutes, something that used to take weeks of human effort. This efficiency is impressive, but it raises a key question for us as contract managers. How do we justify costly consulting engagements when tools can do so much in-house, Carrillo asked. On top of that, the directive for contracts to be mission critical intensifies the scrutiny. Agencies will need every dollar spent to have a crystal clear purpose, and there's less room for ambiguity or general advisory roles. So what's happening now is a confluence of several disruptive forces. They include the retreat of federal spending, AI's encroachment into knowledge work, and a growing skepticism about the tangible value consulting firms deliver relative to their fees. Those forces could mean shrinking federal revenue streams, even as AI pushes potential clients to use the technology on their own, which could lead to shrinking profits, he said. So again, very interesting article. I think a lot of this is absolutely true. I mean, the consulting industry is absolutely getting squeezed. And I do think you're going to see some shrinking, if you will, of some of these big consulting firms, Gartner, McKinsey, Booz Allen, Accenture, the big, big four, big seven, or if you will, in the consulting business. So we'll have to keep an eye on that and see what happens. Already hit the Dollar General thing. This was interesting. Southwest stock jumps on announcement of baggage fees and basic economic tickets. Now, they may have gotten a bump in their stock price. I think this is the end of Southwest Airlines. Okay. Southwest Airlines, they built their whole business strategy. Their whole business model was that was based around this idea of being the low-cost airline. And I love this article because it gets into strategy. Like when you think of a company's strategy, how they go about differentiating themselves from other competitors and everything. So this is Southwest Airlines basically just blowing up their entire business model. And and again, this might help their stock in the short run. I think this is going to hurt, as basically a lot of customers basically say, you know what, Southwest is just like everybody else now, so forget them. I'm taking my money and I'm going somewhere else. But we'll see. I'm sure I'll be talking about that one a little bit more in the future. All right, what else do I got here? I think I just got just two things left here. So I thought this was imminent. I thought this was really interesting. Women will get most of the 124 trillion great wealth transfer studies show, and here's why. So an estimated 124 trillion is expected to change hands by 2048 as part of the greatest generational wealth transfer in history, and women stand to benefit disproportionately, studies show. Here are a few considerations to help prepare. Now, I'll just say I could make some good jokes out of this one. I think there's a good reason women will inherit this money because they will finish off the men. I joke, I kid. Don't get too crazy on me here. And then last thing is, this was an article on the Department of Education cut its workforce in half. How will that affect your student loans? Ultimately, nothing's really going to change. That's probably going to get shifted around into some different departments in the government. So if you're in college right now, if you got student loans, or maybe if you just graduated and still have student loans, don't freak out, don't have a panic attack. I just think a lot of this responsibility, as the Department of Education is wound down, is going to get just moved over to other areas, other parts of the government. Okay. So, all right, that's all the news I got for everybody tonight. So let's wrap up with my two wrap-up items. I got my little story here for the night. So last couple of weeks, I did the first banking crisis in the United States history, which was 1792. I did the first U.S. bank failure, which was in March of 1809. And now I'm doing a monumental event called Black Friday, which occurred in 1869. So Black Friday was a stock market catastrophe that took place on September 24th, 1869. On that day, after a period of rampant speculation, the price of gold plummeted and the markets crashed. It was sparked by a ring of speculators led by Jay Gould and James Fisk, who attempted to corner the gold market. It all started with the Civil War, which the Union government financed with greenbacks, paper notes that were not redeemable for a fixed amount of gold. When the war ended, Congress was intent on returning the country to the metallic standard by offloading gold and removing greenbacks from circulation. Two speculators, however, Jay Gould and James Fisk, plotted to corner the gold market, hoping to drive up commodity prices. They recruited President Ulysses S. Grant's brother-in-law, Abel Corbin, to be their eyes, ears, and mouths inside the administration. Corbin helped tip Gould and Fisk off to impending sales and successfully pressured Grant into suspending gold sales in early September, and the prices soared. However, when Grant learned of the scheme, he ordered the government to flood the market with gold, causing the prices to plunge. That created a ripple effect that sent the stock market crashing, and it sank 20% in a week. Many investors who bought gold on margin were ruined, and several Wall Street firms were bankrupted, but not Jay Gould. He sold as much of his gold as he could on September 23rd after Corbyn warned him of the president's reaction. And in true Gilded Age fashion, the congressional investigation that followed resulted in no charges. Grant and Bootwell were exonerated of any involvement, and Gould and Fisk were spared conviction. And I find that hysterical because it says in true Gilded Age fashion, and congressional investigation followed resulted in no charges. I would tell everybody that not much has changed. If you've ever seen the financial crisis of 07, 08, 09, yeah, nobody went to jail for that either. So yeah, so not much has changed in 100 plus years, right? So okay. Now let me find my quote of the evening. Okay, so watch your thoughts. They become words. Watch your words. They become actions. Watch your actions. They become habits. Watch your habits. They become your character. Watch your character. It becomes your destiny. And as far as we know, that is from an unknown author. But I love that quote. It is a fantastic quote. I hope people will find that one interesting. So now as I wrap up, I basically just tell everybody, if you like what you're seeing, please make sure to like, share, and subscribe, as that really helps the channel. I'm really trying to make that push to 1,000 followers. Make sure to remember we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel. If you haven't checked out the crypto series, the Lords of Easy Money series, or interviews, any of the other number of things that I do here on the channel, please go to the YouTube page and check that out. Or if you're listening on the podcast platforms, check out some of the other episodes that are out there, as it's starting to get it to be a decent number. But I hope everyone has an awesome weekend. Thank you for watching. Thank you for listening again. Love everybody out there. Have a great weekend, and I'll see you guys again next week. Thanks a lot.